If you're getting serious about crypto, you already know that just looking at a chart isn't enough. Valuing these assets and, maybe more importantly, managing their wild swings, well, that requires a much more advanced toolkit. And that's exactly what we're going to dive into today. I mean, this is the million-dollar question, right? It's the central puzzle of crypto. Your traditional financial tools, things like discounted cash flow, they're completely useless here. You just can't value Bitcoin the same way you'd value a company like Apple. So where do you even start? So here's our game plan. We're going to explore a couple of the most popular frameworks the market uses to try and make sense of value. But then, and this is the most important part, we're going to pivot to what's arguably far more crucial, the disciplined rules of risk management that really separate the survivors from the speculators. Okay, first up, we have a model that looks at value through one very specific lens, scarcity. It's called the stock-to-flow model, and it's a really fascinating way to think about digital assets. You know, the elegance of this model is its simplicity. Stock is just the total amount of something that already exists. Flow is the new amount being created each year. You just divide the stock by the flow, and you get a ratio. The higher that number, the scarcer the asset. Simple as that. And this is exactly why Bitcoin is the poster child for the stock-to-flow model. It acts a lot like gold. We know its supply is limited. There will only ever be 21 million coins, period. And its flow, or the creation of new coins, gets sloshed in half about every 4 years. This event is called the halving. It's this built-in, predictable scarcity that the model tries to put a price on. But here is the massive, glaring blind spot of this model. It only looks at supply. I mean, think about it. An asset can be incredibly rare, but if nobody actually wants it, it's completely worthless. Ignoring the entire demand side of the value equation isn't just a small flaw. For a lot of people, it's a fatal one. So naturally, that brings us to a model that does the exact opposite. If stock-to-flow is all about supply and scarcity, Metcalfe's law is all about demand and the power of the network. This law actually started with old-school telephone networks, and it makes perfect sense when you think about it. One phone is totally useless. 2 phones create one connection. But what about 100 phones? Well, they create thousands of possible connections. The value grows exponentially, not just one by one. That's that powerful n-squared effect. So we can apply this same idea to a crypto network like Ethereum. We use things like daily active addresses as a rough proxy for the number of users. And the core idea is that as more people join and actually use the network, its value doesn't just add up, it multiplies. It's the network effect in action. But, and this is a really big but, just like the stock-to-flow model, this is not a crystal ball. Metcalfe's law is a fantastic mental model for understanding why getting more users is so critical, but it's not some magic formula you can just plug in to get tomorrow's price. It's a concept, not a calculator. Okay, so let's just quickly recap these 2 different ways of looking at things. Stock-to-flow is a supply-side model. It's all about scarcity. Metcalfe's law is a demand-side model, focused on user adoption and network effects. Both are useful ways to think about value, but neither one can reliably predict the price. And that leads us to a much more important truth. This right here, this is the absolute key to everything. Since we can't perfectly predict the future, trying to do so is basically a fool's errand. The real path to success, and frankly to survival in crypto, isn't about prediction. It's about protection. It's about having solid, disciplined risk management. So let's get practical. What does risk management actually look like? Well, it all starts with a foundation built on a few principles that are, frankly, non-negotiable. These aren't just suggestions. If you want to last in this market, these are the rules.
All right, pillar 1, do your own research. You hear it all the time for a reason. Second, the golden rule of any risky investment. Only put in what you are genuinely prepared to lose. Third, you have to master your own psychology. That means avoiding trades based on FOMO, the fear of missing out, or FUD, which is just fear, uncertainty, and doubt. And finally, something unique to crypto. You have to secure your assets with things like 2-factor authentication and hardware wallets.
So, with those principles in mind, let's talk about how to actually structure a portfolio. A core idea in risk management is diversification. Not putting all your eggs in one basket. And it's just as critical here as anywhere else. And what's interesting is that in crypto, diversification has multiple layers. You can spread your bets across different sizes of coins, large, established ones versus smaller, riskier projects. You can diversify across sectors, like DeFi or Web3.
You can even spread your capital across competing blockchains, and importantly, hold some funds in stablecoins to act as a safe haven during market storms.
But, and you really have to understand this, there's a limit to how much this can protect you. During a major market crash, everything tends to correlate. That just means when Bitcoin goes down hard, almost everything else goes down with it. Diversifying within crypto helps manage risk, but it won't save you from a market-wide panic. Which brings us to what might just be the single most powerful and important concept for long-term survival in any volatile market. Seriously, if you only take one thing away from our time together today, please let it be this. This quote says it all. This is the technique that professional traders live and die by, but it is tragically overlooked by almost everyone else. It's all about deciding how much to risk on any single trade. And believe it or not, there's a simple formula that takes all the emotion and guesswork out of it. It mechanically tells you the exact amount of an asset you should buy. All you need are three things: your total account value, the percentage you're willing to risk on this one idea, and the price where you've decided you'll cut your losses if you're wrong. Okay, let's make this real and walk through an example. Let's say you have a $10,000 account. You decide you're only going to risk 2% on any single trade. That means your maximum loss is $200. Now, you want to buy some ETH at $3,000, and you set your stop loss, your I'm wrong price, at $2,700. So the risk per coin is $300. All you do is divide your max loss, $200, by your risk per coin, $300, and boom, you get your position size. And here's the beautiful part. The trader buys exactly 0.667 ETH. Now, if they are completely wrong and the trade hits their stop loss, they lose exactly $200. Not $500, not $1,000, a predefined controlled loss. No single trade can ever blow up your account when you do this. This is how you stay in the game long enough to win. So, I'll just leave you with this question to think about. Is your strategy based on trying to predict the unpredictable, hoping some model will give you the magic answer? Or is it built on discipline, where you focus on the one thing you can actually control, your risk? Because at the end of the day, that choice makes all the difference.